Welcome to the Market Huddle Plus, episode 34. I'm Patrick Ceresna with our weekly 30-minute catch-up interviews with past guests. This week, we welcome back our good friend from TG Macro, Tony Greer. Tony, how you doing, buddy?
Patrick, honored to be here on the Market Huddle. I love listening to your show, so I'm honored to be a guest, quite honestly.
We love having you on. So listen, I'm going to dive right into it because there's so much going on in the markets.
Yeah.
I want to talk about all of it. One of the things that we were talking about before we started recording was your idea that there's a transition of leadership. And I really wanted you to kind of dive into this topic, and let's talk about it.
Yeah, so let me set that up for you, Patrick. You know, the first quarter of the year essentially was the Nvidia show, right? Jan, Feb, March, Nvidia just climbed to nearly $1,000, and then things seemed to change against the backdrop of Europe opening up 3 and 4 times levered semiconductor, AI, and Mag 7 ETPs in Europe, right? So they're like working on triple and quadruple levered products of these stocks and sectors that have been rallying, to start off the whole year. That's like a sentiment, like, signal to me, like, whoa, this may be near the highs here, maybe it's stretched. So against the backdrop of that, you had the BCOM, the Bloomberg Commodities Index, which had been negative for 7 months in a row, break that trend. Right. And the chart is really important to me because now I see that ETF that you've got there, and that almost illustrates it, but you can't see it quite as clearly. But what I love about the BCOM chart is that it made a new low below the 2023 low, and then it came roaring right back and started clearing moving averages all in the same move. And, veterans of price action and pattern recognition know that a lot of times that's when a trend resumption happens, right? So the broad trend to me in commodities is higher. Then we had this month of March where we had the 15% rally in gold, the 15% rally in Brent, 5% rally in copper. I mean, things really, really changed there. Everything that went up was hard assets. In the stock market, equity leadership changed entirely in March. Instead of tech running away, the runaway train, tech was mixed to flat. Semis were up a little bit, but everything natural resources and housing outperformed the market, right? They were up 3 to 5%, et cetera, et cetera. Those are the only sectors that really performed in March. So when I see things like that, I see XLE and IGE, the exploration and production and natural resources sectors of the market up 10%. I see refiners firing to all-time highs. To me, like, this is a signal that leadership in the S&P rally and bullish move is changing from the tech gods and the AI craze, which seems to have, at least cooled off and met a sensible market dynamic pullback. And where the intersection of that and, the Federal Reserve, who is just, kind of radically transforming what everybody is thinking about rate cuts. And so to me, this is a really strong signal. And I just think, Patrick, it's one of those signals that you've got to sort of whip out your portfolio and kind of really look around and say, am I prepared for commodities to take the lead? Am I prepared for technology to maybe lag a little bit? Am I prepared for a little bit of volatility in interest rates? And so that's what I think. I think hard assets come in favor now. And I want to let you conduct the interview and stop flapping my gums for a minute.
No worries. Well, listen, thematically, I totally get exactly what you're saying. We've seen that rotation really started over a month ago, particularly when the energy stocks broke out, that really got everything going. The bigger question, just a question in general about how you approach this. Do you take a more sophisticated approach of like doing a long short combination where you're going long commodities against a short tech, or do you just play a single layer where the commodities are working, I'm just going to allocate more of my capital to this idea?
Yeah, exactly, Patrick. And I'm trying to be a little bit selective about playing the breakouts. Like, we're in an S&P bull market. Stocks, I'm extremely bullish the S&P as a backdrop, and we can go over that if you like to. Yeah. But let's stay on the leadership change, which is important to me. The way that I'm playing it is, as oil recuperated its moving averages in the mid 70s, I got back into oil, right? And as the energy stocks broke out to a new all-time high, I got back into energy stocks. And sort of when XME pulled back, I got into metals and mining, and I'm trying to position my book for, this little bit of a sea change where commodities can really perform now. And the one thing I wanted to just add quick against playing those sectors, like all of this is going on against the backdrop of, number one, on the economic side, ISM manufacturing back up above 50, right? That there's a little tailwind for the commodity sector there. It feels like we're in this period where trading is a little bit of a referendum on how far towards World War III we're actually going, right? And if you saw the headlines today, it's, Russia calling out Burisma for potentially funding terrorism through Ukraine. And I don't want to get political or anything like that, but this stuff is hairy. And if we're going to go to a period where several countries of the world are really drawing heavily on natural resources, it doesn't seem to me like the infrastructure is there ready to hand them out. We're kind of
Yeah.
behind on capital investment in various different pockets of the natural resources space, from, probably from oil drilling to gold miners, or however, to copper mining, or whatever direction you want to go. So I think to reach capacity that demand can get to, there's going to have to be a lot of building and growth in the sector. So that makes me bullish that sector, especially what gold and the energy sector have in common. And I'm just kind of lumping them together because they're kind of the same chart, where you've got sustainable bull markets from 30,000 feet up, which came into multi-year consolidation periods and have now simultaneously broken to new all-time highs and broken that set of flat tops that they've been unable to surpass. And against
Yeah.
that backdrop of that narrative, like we just discussed, Patrick, with a little bit more of a sort of war footing and a stronger manufacturing footing, and the U.S. is not slipping into that recession that everybody was expecting in the first couple months of the year. To me, I got to make sure that my portfolio is ready for what could happen now.
Well, interesting. I think, at least in my brain, the way I think about it is that, it was a huge tailwind for the economy when oil prices were able to stay as low as they were for, many months, even a half a year or more. But we have seen in the past, and, we'll talk about your bigger stock market bull theme in a moment, but, and we've seen in the past that when oil makes a huge breakout, that ultimately it's something that the stock market doesn't like. I mean, like think of the first 6 months of 2008 as the first thing that comes to mind, this big commodity bull market, and that kind of derails or takes the wind out of the sails of the equity market. Like, do you think that your thesis could come under stress if oil really starts picking up steam? Like, how do you think about that?
Yeah, I do. To me, that kind of adds a tailwind to my natural resources trade, right? Like if I'm in the right sectors, I can look for those to perform, and it could be a performance against the backdrop of a sort of sideways stock market. So like, yeah, I'm going to
Yeah.
manage the risk in natural resources just like anything else. I'm going to be cognizant that, put it this way, I think that $5 gas at the tank is in the US is kind of where people start balking on usage. Like where,
Yeah.
we kind of got to the $5 mark early in the Biden administration after all the executive orders that spiked the price of gas here and cut off our pipelines, et cetera. So we got to that $5 high mark and we pulled back to like 3 or 3.10. And then we got here now where I think we're at like 3.50 or so. But like, this isn't a danger just yet. Like if things get towards $5 at the pump, then I'll say, whoa, boy, this is a big tax on the consumer. It's a big tax on industry. This could be a problem. But for now, I still feel like it's kind of within the trading range of prices the market is familiar with and not really afraid of, if that's fair to say.
Fair. Now, obviously, you highlighted the fact that gold had this huge breakout, and there's no denying that this is a bull run. I mean, a breakout out of a 4-year sideways trade range to new highs like this is about as as a technician, there's just no debating about this. The bigger question, though, is things like gold miners and a lot of the other precious metals, platinum, palladium, even silver have been in the gutter. Like, let's just use the GDX and look at the miners themselves. But like when you step back and really reflect on this on a bigger chart, like the gold miners are nowhere near bull breaking out the way gold itself has. How do you size this up? Do you think that this is where the gold miners start catching up in a really big way? Does this make you that much more enthusiastic about it, or do you want to focus more on the precious metal?
Yeah, Patrick, to me, this is one of those trades where you better make sure you're in the right security for the right reasons and be careful with the trades that have been historic corollary trades, right? Because I feel like we're looking at a really different environment now. And I think that gold miners have a lot of competition in for the investment dollar, if that's fair.
Yeah.
I'm not a gold miner bull. I still believe that, when you look at the chart of gold miner performance versus gold, the trend is
Yeah.
down, right? They
Yeah. Yeah.
can't perform versus gold, right? And so what's going on here? We've got gold with the bull story breaking out technically new all-time highs, central banks buying, they're diversifying from treasuries, there are physical buyers at market prices. You've got tailwinds of technical breakouts, CTAs buying, like that's the story. That's the
Hmm.
story right there, right? And people are buying that gold for a reason, right? I feel like, Patrick, that the gold breakout coincided with word getting around that US deficits were spiraling at a rate of $1 trillion every 100 days. I feel like as that sort of factoid circulated, people were like, "Oh my goodness, yeah, this is getting really wild. You know what we need is more gold." And I feel like that's the story that people are trading gold off of. And if you're going to buy the miners, just know that you've got that story plus a whole lot of minor headaches attached to it to try to work out. And if you ask me, I'd rather have the pure play story than have the miners with the headaches and the variable costs and whatever other battles that they're facing. It's just like I don't want to fight that fight with them. And the other factor that I factor in is against the timeline of Bitcoin ETFs being launched and seeing a tsunami of inflow. That's probably a better option for that type of trade. Like maybe the portfolio manager looks at and says, okay, my sort of rejection of fiscal and monetary irresponsibility trade is going to be to long precious metal, the hard asset, or I can
Yeah.
be long Bitcoin, that off the central bank system asset, right? And now I've got the ETF that I can express that in. And so why do I want gold miners, right? I feel like there are so many better ways to express that trade for what that trade is than piling on all the risks of having to run the business that pulls the gold out of the ground, if you don't mind me saying it that way.
Right. Do you think, like when we take a look here on the silver chart on the weekly, obviously it broke out of its 2023 highs, still hasn't broken out of its 4-year range that gold has,
Yep.
but certainly approaching the top end of its range. Do you think gold's little cousin silver joins the party?
I'm rooting for it for the people that keep asking me when their silver is going to start performing with their gold. So
Yeah.
it seems like I've involuntarily discovered a pocket of sort of capital that's potentially trapped in the wrong metal right now, Patrick. You know what I mean? I feel like some people have said, yeah, I want to have a metals allocation. Gold at 2K is, those are big numbers and the GLD ETF is expensive. And, they don't look at it in terms of just, I want to have this much capital there. They look at it, how much can I buy?
Oh,
And when they say, you know what, I can buy a lot more silver, and if silver goes to 25 to 50, that seems like a lot easier trade than, trying to double gold from 2,500 to 5K. So let me have some silver on. And then I get when silver lags, I get 10 emails about my bullish gold email, my bullish gold newsletter that's saying, hey, why is silver not performing? And I'm like, it's not performing because you want it to perform, but you're not in the right metal right now.
right.
You know what I mean? Like when silver makes a new all-time high with central banks buying and diversifying their portfolio away from dollars and, a little bit more of an uneasy global footing, like when silver's trading a new high on that, wake me up. Like, it's just, to me, they have been disappointing trips to the top of the range. I don't want to get caught up in them anymore because I've been there.
Right. You basically want the momentum to be your tailwind, and therefore you're like looking at the relative strength and which ones are the ones that have that relative strength.
Yeah.
Um, uh, what I wanted to move on and talk about another metal, industrial metal that's been ripping, but it's not just that copper has been doing well, but some of the copper miners like Southern Copper and Freeport McMoran have been on fire.
Yeah.
Now, so first of all, copper now approaching its 2023 high,
Hmm.
and certainly in a bull trend. And I know you were mentioning earlier something about the copper story, particularly when we had Paulo Macro on the
Yeah.
Huddle just recently. I'd love just you to talk about copper and what's your take, and if you want me to pull up any charts, let me know which ones.
Well, first, but yeah, you may as well just put the copper. The copper chart is fine, right? Because I have to give you kudos where you deserve them, Patrick. Because listening to Paolo talk about copper the way he did helped sort of get me over my anxiety about like sort of why copper isn't higher and why my XME position isn't doing better than I expected to. And just to read it, when he came out with the quote, when he said, "We've been working the length out of the market and disinteresting and frustrating people for 2 years. This thing is going to go," right? And he says the move out of it is a function of how long and the level of max frustration it took to put the thing to sleep in the first place. And if you've been in the markets for a long time, you know that there's so much wisdom in there, because they literally, I was like, I was pitching the Freeport McMoran story in 2020 and in 2021 and saying, man, there's not enough copper out there. And this is a $45 stock that could double from here. And guess where we are now? $45, $50, right? Like we're at the same
Yeah.
levels in Freeport McMoran, and copper still hasn't gone through LME 10K or 11K, let's call it. That's the real high.
Yeah.
Right. And so you're sitting here saying, man, if we're going to make this push towards electric batteries and the inventories are as low as they are, and, this seems like this is set up to be a total, real commodity shortage story. And it just never happened. So it seems like things are different. It seems like you just have to have the sort of faith, and you have to believe that this thing has lulled us to sleep for so long for whatever reason, that maybe it's going to have its moment in the sun and really go, and it's just a lagger. So I can go with the copper story a little bit more than I can go with the silver story, because I just think that
Yeah.
that copper's got better fundamental tailwinds.
Yeah, like look at that Southern Copper chart. I mean, it's literally gone parabolic here. It's if I told you that this was an AI stock, you'd believe
Yeah,
me.
literally,
like,
it looks like MSTR, right?
yeah, like it's insane the pure momentum that's just coming into some of these different copper plays.
Yeah.
So and yeah, I mean you're also like playing it from the XME perspective, right?
Yep.
And I mean, is this look at on the weekly chart basis? We're just approaching the 2022 highs, and you think that another full run is on the horizon here?
Well, I love the momentum, Patrick. Just like you're pointing out, it's like this is kind of how this sector trades. It's kind of student body right and everyone's in, or student body left and everyone's getting out. And we're back to that. We're back to that pace where you look at the membership of that ETF, and it's a lot of big gold miners and a lot of big silver miners and a lot of steel companies, and it covers a lot of bases. And so I like the momentum of that, and the way, with the backdrop of the way, aluminum and copper and zinc have all woken up in the last month and all of a sudden just changed their behavior pattern and trajectory. So here up above those, those highs around 60, 62, I can think about adding my position and managing the risk from there. So I like everything that's going on with XME. It may be a little bit of a
Yeah.
slower grinder higher than gold even. It may lag gold. Copper and silver may lag the yellow metal for the first time in like history when they're all going up. It's always like, copper in the lead and silver right behind it, and then gold's bringing up the rear up a couple of percent. But it feels like that may have flipped now. So we'll see how it plays out, Patrick. But I think you got to stay on this natural resources path as closely as you can right now.
All right. Well, listen, we're almost running out of time, but I wanted to just talk about the equity markets here,
Yeah.
and obviously we're in this huge bull run,
Yep.
and See, I have a very different wiring than you do. Like I am the wall of worry. Every time every time this thing runs, I'm like, oh, it's gone too far. It's gone too far. Like, it's gonna fade. Yeah, and you're much more of a man. This thing is running. It's gonna keep going kind of guy.
Yeah,
And
yeah,
like that. That's what makes a market, right? It's
yep,
not about
yeah,
right or wrong. It's but I mean, you though have this view that these kind of bull markets can be far more sustainable.
yeah.
I'd love to just get your thoughts on what's how you approach the market here at these kind of levels.
Yeah, yeah, Patrick. I look at it. People throw all kinds of metaphors and analogies out when markets behave in a way that reminds them of something else. And everybody has a tendency when a market is flying to its highs to say, oh, the analog is just like right before this crash. And it's right before that crash. And I started looking into a couple of those analogs from a couple of different angles and realizing that like, no, like things are different now. And so I'm gonna tell you that the analog that I see is the analog to 1994, which was similar to 2023. And in 1994, we were coming off a hot economy, flying GDP. We had inflation super hot, and we raised Fed funds from 3% to 6%, essentially, from 93 to the middle of 94, where they traded a high of 6%, right? For the next five
Right.
years, Fed funds stayed between 4.5% and 6%, and inflation bobbled around. Sometimes it was hot, sometimes it was a little cooler. And the fact that the high in Fed funds was clearly in the rearview mirror, the way the Fed managed it, the stock market took off and loved it. And it was up 34 while it was the S&P was down 1.5% in a really
Yeah.
volatile year of 94 while we raised rates just like we did last year. 1995 was up 34% with Fed funds in a range. 96 up 20%, Fed funds in a range. 97 up 30%, Fed funds same range. Right? So the market
Yeah.
recognizes that data, and I'm not saying that the Fed is going to be able to pull off the exact same thing, but I feel like when the inflation bug comes back and starts biting, they're going to squash it, and it's going to keep Fed funds in a range, and they're not going to have to raise much, and they're not going to have to loosen much, and inflation's going to heat up and it's going to cool off. And to me, as long as there is no extremely fast move higher in the curve, which will indicate, economic weakness and the tendency for the Fed to cut rates, with the twos tens curve sitting here snug as a bug in a rug at minus 35, 40 basis points, where it's been for the last 6 months, man, those are bullish conditions. That's green light go for the stock market in my book. And especially
So
the last point, sorry to interrupt. The last point is
yeah.
just we've got the AI technical tailwind and the sort of cryptocurrency technical tailwinds, just like in 95 when we had the, computer
Yeah.
software tailwinds and the Amazon craze and the, .com everything. And so that's the analogy that I see.
Yeah, and that's where I was going to come with the question. Like, ultimately, you see a rotation. You had started the interview with the idea of this rotation,
Yep.
but when you look at the composition of the S&P 500, it's incredibly heavily weighted into those Mag sevens.
Yeah.
And the thing is that in my mind, the way I think about it is that in order for the S&P to keep plugging away, with the rotation being the dominant theme, would mean that the breadth of the market would have to be incredibly wide, huge leadership in energy sector and other areas like this to compensate. Like, how do you kind of view it that with this kind of huge bulking of market capitalization in those big names,
Yeah.
for this S&P to sustain trend, do you think just maybe that these Mag 7s continue higher, just not on a relative outperformance basis? Like, what is it? How would you kind of view
Yep.
when you hear me talk about it this way?
Yeah, I totally understand your question, Patrick. And the way I look at it is that Mag 7 is in the lead. They've been the lead performers and driving the performance very much. And if we have a sector leadership switch where it's all natural resources, which are much smaller portions of the indices, maybe that happens against the backdrop of rising rates or rates at the top of the range like they are now. And so under those conditions, You quite honestly, you have big tech and the stuff that weighs on the indices. You have that stuff going sideways to maybe a little bit lower, just not performing very well. You have
Mm,
natural resources stuff performing, home builders and housing performing, because those are secular bull markets, and you only need, a couple of other cyclical sectors to participate in that rally. And if banks can participate and healthcare and things like that, then, the bull is going to keep running. And it's just going to be like, oh man, these, all of a sudden these semiconductors can't get out of their own way.
yeah,
Like, what the fuck is this all about?
yeah,
And so I could see that happening. And maybe what the net result for the S&P is that we have a couple months where it goes nowhere. It's up 1% or 2%, it's down 1% or 2%. And then, we'll get to the next phase where maybe we, face a period where rates are back to the bottom of the range. And what are they going to do during that? They're going to sell the commodities because that's a deflationary signal, and they're going to buy the tech back. And then you're going to get another leg up in the S&P.
right.
So I feel like it's just going to seesaw back and forth from kind of the Mag 7 being a leader to the Mag 7 being a kind of a drag. And then we'll see what happens in between. But I think the S&P survives it.
Well, listen, you know what? I will have to admit, I was a little skeptical about your home builder call, and it ended up being spectacular, and I looked like a fool. But that's the way it works, doesn't it? Anyway, listen, I'm very curious to see whether things keep plugging along the way you're suggesting. It's certainly there's a whole array of investors that are hoping you're right. So
yeah, exactly.
Anyway, listen, Tony. Before I let you go, I just want to let you do a shameless plug for yourself. Where can people find you and follow your work?
You're too kind, Patrick. My website is at tgmacro.com. There are samples of the Navigator newsletter on there. I have a point lookout package, which opens you up into the TG Macro Slack channel, where there's 100 traders talking about markets all day long. And I have a Substack at tgmacro.substack.com that I call Navigator TV, where I put market updates and interviews with people in the markets on that channel as well. So, or on Twitter at tgmacro. And I think that covers it, man. Thanks so much.
Tony, it was great to have you back on the show. Listen, I'll get you back in the third quarter, and we'll see how things have played out.
Oh, I love it. I'm honored to be on here every time, Patrick. Thanks so much for giving me
thanks,
a place
Tony.
to chat.
Have a great one, buddy.
You too, man.
Cheers.
Cheers.